Welcome back to Season 8 of Talking with Traders. This is the fourth year of this podcast since it began in 2020. Once again, IG Markets have come on board as the sponsor of this podcast. We're truly grateful and privileged to have such a global leader in CFD trading as our sponsors. In the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some of these will be past guests that we invite back onto the podcast, and some will be new guests. The idea is to attract a broad spectrum of different perspectives from players in different areas of the markets. None of what you hear here is financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here to your own trading and investing. Remember to subscribe to the podcast on your favorite podcast app. That way, you'll be notified when new episodes are released. Once again, thank you to IG Markets for sponsoring this podcast into its fourth year. And thank you, listeners, for your continued support of this podcast. Now let's get into this week's episode. Welcome back to another episode of Talking with Traders. And this week, it gives me great pleasure to welcome back a past guest. This is his third appearance on Talking with Traders. His name is Richard Thomason. And why I love interviewing you, Richard, is because you're a regular guy. You're not a market professional. You don't work in the industry. You never have worked in the industry. You're just a relatable guy, like many of the people listening to this podcast probably are, going about your trading, your investing, managing your own portfolio, and quietly making quite a good success of it. Certainly that was the case when we last spoke. We spoke the last time in November 2021. I can't actually believe it was that long ago. So more than 2 years ago, which is this conversation and this update is long overdue. But welcome back to the podcast for the third time. And how have you been? What's been happening in the last 2 years since we last caught up?
Thanks, Garth. Yeah, it's great to be invited back on your podcast. And, I've listened to most of the episodes, kind of when I run, I try to download a podcast or two. And it's been fantastic to see it grow, actually. You've had some incredible guests on your show. So kudos for kind of ratcheting up the ante there.
Thanks.
Some really, some good names. And I've learned a lot, certainly. So well done to you on that one. And I can't believe it's been, over 2 years since we spoke, or November 21 is quite a long time ago.
Yeah.
So quite a lot's changed. So I think the last time we spoke, I just left big corporate. So I was at a company, AB InBev, which most of you would know.
Mm-hmm.
And I've stepped out into a smaller business in spirits distribution. And I'm kind of multi-hatting there, as you would do in a small business. But it allows me a lot more flexibility, a lot more room to kind of use my brain and think and contribute straight to the bottom line, and to kind of steer, even though I'm not a shareholder in the business, to steer the direction of the business and to add value. So whilst I really enjoyed my 15 years at AB InBev and feel like I contributed there, it was a nice safety net, a nice start in life while I started a family. It's great to be in doing something different and having some flexibility to go and watch my kids go and watch my kids play a few sport matches, to do some drop-offs in the morning, etc. And then on to markets. Wow, markets are continue to be interesting. So, wow, I mean, if I just kind of take you through the last few years, it's been a real roller coaster. So, locally in 2021, I did 40% and outperformed the JSE by 11%, but my US finished well green, but behind my benchmark, which I wasn't pleased with. 2022, the indices ground lower and I finished in the red, I think, on both accounts. And then last year showed a gradual uptrend and then a sharp sell-off, if you remember, in August to October, and then a huge finish at the end of the year, which kind of left most people's accounts finishing in the green.
Yeah.
So that was sort of out of nowhere, and it took the emotions from right down the dumps to kind of, for a long only person, to ending the year feeling elated and thinking that the Fed's going to cut rates sooner than expected. And then, we got inflation data out today and the market went into a tailspin.
Yeah.
It's the 13th of February today, 2024. And so this year to date, I'm in outperforming quite a large margin. Offshore, I find myself up over 13% year to date, but the SDY is still negative, which is my benchmark. And then locally, it's been quite limited. There's limited opportunities in liquidity at the moment. And I'm slightly in the red there, but ahead of the benchmark. So,
Okay, good.
yeah.
When we last spoke, your portfolio was quite heavily skewed towards South Africa. When I listened, I had to listen to our last podcast again because it obviously was such a long time ago, just to update myself. And when we last spoke, you had about 85% of your portfolio in South Africa and about 15% offshore. Now, I had a look at it since then. The JSE hasn't done very well in Rand terms. It's very slightly up at an overall all share index level, but in US dollar terms, the JSE is down about 15%. If you convert it back to dollars, and that's in sort of 2.5 years now. So how does your portfolio look now? Is it still heavily skewed to South Africa, or have you diversified more out of SA into the offshore shares, or what?
It's quite funny because I went back and had a look at the ZAR USD in November 21. It was trading at 15.45, and now we're looking at 19.0 something.
Yeah.
If I take you to where my Rand balance of my US account is, it's at an all-time high, yet it's off its dollar highs in a drawdown.
Right.
So it's Rand appreciation. And funny enough, I thought the split would have been skewed more to the US, but it's actually 16.84. So it's kind of stayed where it is. And hindsight's an exact science. If I'd known back then, I would have, and there have been times in the past, I just thought, cash out the whole Rand portfolio, put it all offshore, and at least I won't get taxed on the Rand depreciation, for example, because there's talk that capital gains is going to go up to 50% in this country as well. So,
gosh, yeah.
So maybe that's just get talk, but in hindsight, I wish I'd put more offshore, and especially after seeing the gains of the last 4 months, and maybe it looks quite stretched at the moment, but there's a lot more opportunity offshore at the moment, certainly.
Yeah, there is. And it's always a tricky one. I know what you say, because I know when we spoke the last time, you said you live in SA, you eat in SA, your kids go to school in SA, your costs and your living is in SA. So it's understandable you do have a kind of a home bias. That's quite a normal thing to have. But you're right. The JSE, I find, is getting more and more limited in terms of opportunities. Not only because the market's quiet, but also a lot of the stocks have been delisted or bought out. So it makes for a far smaller universe of stocks to trade. Whereas, like you say, if you go over to the US, there's just such a massive ocean of opportunity of various stocks and different themes and things that you can play. But
there's always something performing overseas, in some sector or class,
There is, but it's also, as you say, I know being a South African investor, you always kind of look at it and think, oh, when is the right time to sell your rands? Because you worry, maybe one day the Rand does suddenly strengthen by 20% and you've then externalized all your funds, and it's, you timed the currency wrong. So I know it's a tricky one to get right. And also the US market, although there's a hell of a lot of opportunity out there, I know that the companies are often a lot less familiar than what the South African ones are on the JSE. But it's interesting that your split is still more or less the same then.
It is, and I must just say that that's obviously my active trading accounts that I manage. There's obviously there's the domiciled preservation fund and provident fund and RA here, and then I've got some passives which are very much skewed to offshore type of things. Satrix World Market and Satrix Japan, which has done quite nicely, and things like that.
Yes.
Sorry, not Satrix Japan. Whoever the provider is that has the Japan.
Yeah, I know what you mean.
I think it is.
Yes, Japan's broken out and it's trading at close to what's getting towards all-time highs again. But the Japanese market peaked in 1989, so it's it's been 40 years of nearly 40 years, or 35 odd years of weakness, and trying to get back to those all-time highs.
Yeah.
You mentioned previously that your investment process is quite simple, and it's actually very often it's around listening to other market commentators, guys on the TV, on the radio, reading magazines. It's just keeping your ear to the ground in that respect. But also that a lot of what you did is just common sense investing. Your eyes are open. You've got a critical eye, able to spot opportunities just by being aware of your surroundings and what's going on in the country. Is that still more or less the way that you approach your investing and trading, or have you adapted it much since then?
I'd say yes. I do still try and invest with a fundamental brain. I listen to a lot of people, a lot of podcasts on the way to work. I have my morning routines. I'll listen to MoneyWeb podcasts. I'll listen to commentators that I respect. I particularly like David Shapiro and Wayne McCurry. They're old hands at the
Yeah.
JSE,
Yeah.
and they really know what they're talking about. And David really does well offshore as well, and has some good insights there too.
Mm.
So I listen to these chaps, and I still, like I said before, I turn these ideas around and like a rotisserie in my head. But a lot of what I do, and I think you are probably a similar trader investor like this, Garth, is I go through a lot of charts and I try to look for things that are trending,
Yeah.
things that are showing an uptrend already, and that's already established, a
Yeah.
promise of a breakout, some good
Yeah.
volume signs, something
Mm.
that's not too volatile, because I want to be in a trend that's not going to shake me in and out like a Naspers that will go up one day and the next day China's out of favor and the next day gaming's unbanned or whatever. So those sort of things I can't get my head around, although I'm mindful those things are moving the indices in a big way. So
Yeah.
if I'm going to outperform it, I need to kind of be very smart in some other way.
Mm.
So, a lot of what I'm doing, and I think, is just based on kind of intuition that's been built up over many years of looking at charts. And, for instance, like PGMs, I didn't, we saw a rally middle of last year, and I actually took some, I think towards the middle of last year, and I knew that, these things can move up or down. They're high beta plays very quickly. So I was out of that AMS trade quite quickly. And then I think it was in November, it sort of made another run up, and AMS in particular bottomed at 581 and then ran up quite quickly. And I thought, oh, I've missed it now. And people were still really abuzz with this whole PGM theme. But in my experience, if you move back to say 2018, nobody was really talking about PGMs. It was quiet, and the likes of John Bickard were kind of considered a pariah for investing in these stocks.
Mm.
I still don't think we've bottomed. So anyway, that's just my view on that particular one. So a lot of what I'm doing is based on those things I described before, but I am trying to weave some sort of intuition in terms of where we are in the interest rate cycle. And a lot of what the Fed does pretty much moves markets these days, and obviously the local SARB will follow
Yeah.
suit. Yeah.
Yes. Yeah. Yeah. Absolutely. Okay. And I mean, you're an engineer by qualification. So, and I know in engineering, things are quite black and white. There's quite a neat cause and effect relationship to things, whereas the markets are anything but that. They can behave in the most strange, irrational ways at times. And obviously that introduces all sorts of risks. How do you marry that sort of that being an engineer, having cause and effect relationship, but then having to bring that into the markets, and where you've got this risk that's it's not clear, it's not black and white. How do you mitigate against those risks?
Sure. So, I mean, I think what engineering taught me is firstly to love charts, to be logical, to be methodical, and to always kind of seek for answers. And I've got a lot of books here to my right hand side. None of those provide the answer. I still haven't found what I'm looking for. And the market will always be irrational, I think, and that's what makes it such a beautiful place to kind of play in. People will be on Twitter and they'll be like, oh my gosh, Alibaba is so undervalued. I can't believe it. Look at the free cash flow. It's like the best ever per share. And other shares are trading off at 200 PE and they've doubled in 4 days or a month. And how can the market have it wrong? And I mean, I'm saying, like, are you saying the market's wrong, and you're right, or is there something that missed? Because this is a consensus on a big Chinese tech stock, so there's something here you have missed, or it's not the time for the stock yet. So why are you tying your money up on the stock that's not moving? It could be another year before it goes up. Why don't you just wait for it to go up? That's my view. And I know there's a lot of ways of making money in the market. So when I first started out, as an engineer, I thought if I could just go through these RSIs or stochastics and find the holy grail, there's no real holy grail. There's no cause and effect like you see so often in engineering. There's no proof of principle. Um, so, I think it was just about, through time, you learn that sometimes what you do will result in a desirable outcome and sometimes result in an undesirable outcome. And what you hear in so many of these, so much of the time is that you should trust your process rather than the outcome. So you have a good trade. It can be that you followed a good process and you got a bad outcome, etc. And I think you just got to really control what's controllable. And once you can only prepare so well for a trade before you enter the trade. Once you enter the trade, there's a whole lot of emotions and different emotions going around in your head. It might affect your sleep. It might cause you to be moody. And if that thinking or clarity of thought is being sort of jaded and something's wrong and eating up inside of you, the only way to stop that is to cut that loss. If you've violated your stop points, you know that you should get out and on it stop. And the only way that you're going to feel better and stop that nausea or that eating up that cancer inside you is to cut loose. And it's like, that's so it's about taking the power back. So I guess it was about just learning that it's not always a cause and effect relationship. And I've learned to just love the fact that you can never predict it. The brightest minds in the world never get it right. No. There's always something. It's like history, but it's never always the same. And then just, in terms of mitigating losses, of course, I've learned to never take a big loss. And the only way to do that is to kind of eat your humble pie and say, I was wrong. Strong opinion, loosely held. I was wrong. Guess what? Don't remind me of it forever because I've changed my mind and I'm out and I've moved on to the next trade. So, don't call me a loser for doing that.
No, well, hey, the best loser wins, right? To quote Tom Hogard.
Fantastic book, that,
Yeah, it is a fantastic book. I've just finished listening to it, and we'll talk about books at the end of this podcast. But that is a fantastic book, and I'm trying to get Tom Hogard back on the podcast. He's not the easiest guy to pin down, but I think I might get him in March sometime. I'm hoping so.
Wow. So, that'll be a great one to listen to.
Yes, I'm sure it will. He's always good to listen to and good to chat to. You don't make any use of any leverage, right? I know when we spoke previously, everything is spot equities. You don't do CFDs or futures, or has that changed?
Still hasn't changed, Garth. I'm a man of habit, and I should have, in hindsight, the last few months I would have absolutely killed it if I'd had some leverage on. And I'm really a disciplined guy, so I think I could have the discipline to cut my losses very quickly. It's a mark-to-market game, as you know. So it's in black and white at the end of every day. You can't just hold on for another day. You've got to consider cost of carry and all that sort of stuff. But funding your account is not cheap as well when interest rates have gone up. But
that's true.
I tend to just stick with vanilla equities, and let my upside winners run. It takes a bit longer, but I'm often happy to be patient.
Let the winners run and cut the losers. Water the flowers, cut the weeds.
It's
good. It's a very good principle, and it's very simple, but it's hell of important to manage your risk and to see growth in a portfolio. And in terms of number of positions, I know when we spoke previously, you had about 10 trades on at one time. Have you changed that? Because that's quite concentrated. I made that point the last time we spoke. It's quite concentrated, but I liked it in the sense that it's concentrated enough that it can really move the needle when it goes well. But also, if you then combine that with your stop loss and risk management approach, then it means that you're never going to lose your shirt if one goes bad. I thought that was very good. Is that still much the case, or have you changed the makeup of the portfolio, the number of stocks in the portfolio?
So right now, Garth, I've got 7 positions open on the JSE, and 5% in cash. In fact, today I sold one because I have a tax obligation which I need to fulfill because it's tax return time, and 7 in the US with 0 cash. Right. And just to let you know how I how I manage that cash is if I've got a reliable trender in my local portfolio, which, as I said, at the moment, none have really taken. I'm in the green on them all, but they haven't really trended like some of my US stocks. I'll concentrate that 5% probably into one of the same names that I hold already. So I would have 6 positions plus that 5%.
Okay.
So yeah, when I size it, I still size it the same way. I kind of not looking to lose more than 2%. But I would generally go in with an R, which is like not looking to lose more than 2%.
Yeah.
And then if it goes in my favor, the position must be green and must have broken to new highs and proven itself onto a trend. And then I'll probably add another half R, and then I'll be done. And that's only if I have cash in and not fully invested in other positions.
Right.
Yeah.
And have you had a situation where you get a winner that becomes so big that it becomes disproportionately large in your portfolio to the extent where it's, what maybe started as a 10% position or something becomes a 30 or 35% position, which is hugely concentrated? And in the fund management world, you can't let that happen. You've got to trim the winners back if that happens. But it's so prohibitive. And in your personal capacity, I mean, obviously you don't have to abide by those rules. So have you had that sort of situation where a position, you become a victim of your own success by seeing a winner become disproportionately big in your portfolio?
So right now, it might surprise you that I've got 2 winners in my US portfolio that are greater than 100% up, and they make up now 20% each or 40% of my entire portfolio, and they're working now.
Yeah.
It's not NVIDIA, it's not super microcomputer, it's not ARM resources or these other chip things that are going ballistic, but yeah, they're working nice and slowly, and there's some other ones that are starting to build quite nicely. No, I won't trim them. And I guess how that'll work its way out in the future is that it'll work like a market cap, I guess, weighted index, where they'll either start to underperform at some stage and they'll get stopped out, and I'll just close the whole position, because that's how I work with these when trends start to fail. Or they'll just take a lesser place in the portfolio and others will catch up and they'll just kind of even their way out,
Right. Yeah.
But I firmly believe that you need to let these winners run, because that's when trend following comes into its own. And I think it's something I've never struggled with, to hold a winner. It is very scary when it starts to pull back, because you start to lose big numbers very quickly. But as long as you've got your uncle point and exit point, then I'll get out. And if I've got a built position, I'll exit both of those positions immediately.
Right.
And I think one of your previous guests, James Gubb, said it takes guts to be a greedy pig. So, we've really got onto a trend that's working well. And, if I had been one of these NVIDIAs or whatever, the guys will say, yes, it's overvalued, but I'll ride that thing to the last drop.
Yeah. Yeah. Well, that's it. And you need
changing money now.
Yeah, totally. And just one or two of those home run type of trades, 10 bagger or whatever, makes all the difference in a portfolio. And even when it's not a leverage trade, it can make a hell of a big difference in the long run.
Yeah. So sometimes, it takes you so long to find these darn things. So I think, enjoy the moment, enjoy your time in the sun, let it run,
Yeah. Yeah. No, fantastic. Well, it's good. I mean, as you said, you're a disciplined person in life in general. And I know when we spoke before, you've had a couple of interesting challenges over the years. I remember your goal in I think it was 2020 was to read 50 books, and you did it. I know also last time we spoke about the Bright Kamalo's R1 per day challenge, where you save R1 a day, and then tomorrow it's R2 and R3 and R4, and you do that for the whole year, and you end up, doing that for a whole year. You save about, I think you said 67,000 Rand or something like that. So these sort of things I know appeal to you. Tell us a bit more about the stuff that you've been doing now outside markets. We know you're disciplined in markets, but let's keep this interesting. I know you've got a couple of interesting things that you've done beside markets, beside trading, which has tested your your physical limits and your discipline.
Yeah, so the reading was really just, I started getting bored in COVID and started reading a lot of books, and it was quite an interesting time. The savings challenge was really just to build a bit of discipline, not really to try and build any sort of wealth, anything like that. As you know, well, you may know, I'm quite a serious runner. recently we actually spent quite a lot of money, so I'd say I engaged in the spending challenge. So, but no, seriously, we last July we went over to, or it was June, July, I think we went over to the US, to California, and I took part in a race called the Western States Endurance Run.
Okay.
So this is the oldest and probably one of the most iconic trail runs in the world, which took me a decade to get into. So they have a list of qualifiers. You have to run a 100K race or a 100-mile race on their list, and then you get one ticket into the barrel. And if you don't get drawn, you have to do another qualifier on their list, and then you get two, so they double your chances if you don't get drawn. And so it goes up. And with a bye year and COVID and everything, it took me literally 10 years. So when I finally got drawn, I got so excited. And after partying that night, I finally, recovered from that and hired a coach. And then went over there. It was like it was Christmas for me as a kid again. And it was amazing. My family was over there, and one of my best friends seconded me, and my boys ran the final mile with me. It was actually one of the most fulfilling experiences of my life. I actually get quite emotional talking about it.
Yeah.
And then we came back and did some renovations on the house, which was also testing. Which, if you've done renovations, you'll know about that.
Yeah.
But what I really love about endurance running is it just forces you to be in the present in that moment. There's a lot of strife you go through, and there's a lot of parallels to trading, and particularly in long running like that, where you run for sort of 24 hours, you go through these deep emotional lows where you want to quit, and then you also, when you finish, you get this unbelievable euphoria. I'm not really one that's taken drugs and knows what that feels like, but unbelievable highs that is totally on the other spectrum, and that you can kind of relate that to trading in a way. And also you kind of reach a point where you want to quit, and you either quit at your goal time or you quit the race in its entirety, and you kind of have to make that decision in a split second.
Right.
How badly do I want this? Do I want to fight and carry on through the pain, or do I want to take it easy and walk to the finish, or get in a car? So
wow,
it was an easy decision going to the US and spending that money going over there, making it after 10 years into the entrant list. So I was never going to quit that one. But in all endurance running, you kind of reach this point in your brain in the race, you kind of 2/3 of the way in, so you've got a long way to go, but you're no man's land. So that's what I did recently. I'm still doing a lot of running, and it also requires a bit of discipline now and again when it's dark or raining outside.
Sure.
And it gets harder as you get into winter, and I'm sure it's even harder in the UK where you are, guys.
Oh yeah, tell me about it.
I know you do a bit of running, so it's
I do. I haven't actually done a lot of running because I hurt my knees last year, and but I've been so I've started actually rather doing some strength training, which I'm really enjoying, and I do that 3 times a week, and I'm loving that.
That's so important as well,
Yeah, absolutely, it is.
Core and strength,
Yeah, especially as we get older, I find that your muscles start to atrophy. And it's interestingly, the guy at the gym, when I went to go and try it out, he obviously, I don't know if he did pick up that I'm a financial guy, but he just said to me, he said, see this like your pension. What you put in at the gym now, you will reap when you're an old man. And that just sold it for me. I was like, absolutely. So it is. I mean, again, talking parallels, life to trading and what have you. Looking after yourself, looking after your physical health, looking after your financial well-being. All right, and what else? I mean, you said in the preview to this when we were off air that you met up with some FinTwit traders over the years, and you found that quite an enlightening experience. Tell me about that.
Yes. I think, last year I actually ended up meeting, I don't know how it started, but I met up with 5 people over the course of the year. And what really struck me out of that whole experience was how different people are as traders. And I always thought, it was quite clear in my mind how I traded, and I was very cognizant that it's very, different ways to make money in the market, depending on your time of reference, what you do in the day, your personality, etc. So the one guy, doesn't use charts at all. He just uses price action. This guy's in Durban. His name's Alvin Govender, and he's become a very close friend of mine. Actually, we talk a lot and we joke a lot about people, joking with people on Twitter and things as well off there.
Yeah.
I met another guy in PE, and he is a contrarian. So he adds to losers, like Pick and Pay's fallen from grace, and he'll just buy more and load the boats and wait for it to come back.
Okay.
Which I cannot do, but it's worked for him.
Okay.
And then another chap who was kind of a beginner and looking to just network. So we chatted through, and you always learn something from each other. The other guy was a youngster trading the Forex markets, and he's a day trader using a 1:1 risk reward ratio. And then the fifth person was Dylan, who I know you've interviewed as well. And we met up at Vasco da Gama, which is just down the road from our offices, and we had a beer.
Yeah.
And he's actually probably the most similar trader to myself, although he takes a lot more positions, but he uses technicals and charts, and he's looking at similar names and stuff. So that was also very interesting. Although I haven't had the portfolio management experience that he has.
Sure.
And exposure to traders, but we very much talk the same language, and I enjoyed his interview with you.
Yeah, that's Dylan Bradfield for the listeners who are wondering who we're talking about. It was a good interview, and he's a very good trader. I'm on a WhatsApp group with him, and he's hell of a sharp. He's really got his ear to the ground, and he knows what's potting. So that's great to catch up. Now, what's in the future for Richard Thomason looking forward now?
Sure, Garth. I mean, I think I'm quite lucky to have kind of fulfilling work at the moment. I'm in no rush to kind of retire. In fact, I don't think I'll retire at any stage. I think the markets will always keep me interested and keep me sharp. I have done a lot more sort of thinking about life. My kids are getting older. My one kid started high school this year. So I'm thinking about what's after that, what happens when he leaves home and I'm left with this house that I need to downscale and things. So I'm really thinking ahead, but I've still got a lot of energy left in me. And, I'd like to think that I'm kind of one step out, towards being a full-time trader. Perhaps that'll still happen one day. And it's still something that really excites me. So, I'm continuing to read my books and look at the markets and hone my system and be a student of the markets and continue to learn. So,
yeah, brilliant. Yeah. Have you read any books you can recommend? I mean, I know you're a prolific reader, so and we've on both of the occasions we've spoken before, you gave us some great book recommendations. Anything new that you think we should be looking out for?
So I mean, one that I've drifted a little bit towards. I've read a lot of books on trading and investing now, and I've drifted a little bit towards Mindset of Champions, and I'm very interested in what makes sort of Kelly Slater want to win the Pipe Masters at 50, and Rafa Nadal and Jocko to keep going when they've got all the money in the world and all the fame and everything. And so, what's the mindset of a champion look like? I picked up a book called Tools of Titans by Tim Ferriss. I wasn't really a fan of his sort of persona as per se, but I picked it up. I know Mandy Rafsanjani, who's a trading coach, she was talking about on one of her podcasts, and I really loved it. He explores, it's pretty much a distillation of the best content of his podcasts, and these are long format podcasts, like 1 to 2 hours, sometimes 2.5 hours. And he gives a lot of book recommendations from his listeners, from his interviewees. And then I'm busy working through the top 25 most downloaded Tim Ferriss podcasts at the moment.
Wow.
And then I've started to reread some classics, and here's one that you might, I know you like this name here, this Pitbull.
Yes. Brilliant.
I'm about halfway through a reread of this, and it's the guy's humor is amazing, and the numbers that he kind of put out, and I don't know when it was like the 80s or something.
Yeah, I think so, because he was a pit. Yeah, as the name suggests, he was in the pits in Chicago trading.
He was a pit trader, but I mean, he said by the end of November I was down $57,000 for the month. In December, I made $928,000 and ended the year up over $3 million in futures alone.
Yeah, and that was a long time ago.
After losing $800,000 on one trade, that he came back and finished positive like that. So it's just so well written. It's probably one of my best books, to be honest.
Yeah, so I read it many years ago, and I'd love to actually get it again. And because it was an absolute thrilling read. So you've reminded me, actually. I'd be keen to read that again. It's very,
I
very
read it
good
on
book.
Kindle, and then I picked up a physical copy, which I always love. And so I've just been leafing through that and chapter by chapter and picking up some nuggets here and there. And just loving the way the style it's written. You can really fly through it. It's kind of like a Michael Lewis book. Yeah.
Yes. Yeah, it is very well written and great. I mean, I do enjoy those kind of sort of story books, although it's true, but it's also a bit of a story, a bit of a autobiography of his life, really, as a trader.
I mean, he takes you through getting into trading and how his wife supported him. And he had a birth of a kid, and his wife got breast cancer, and then he realized he needs to spend some money, not just save it up and and things like that. He takes you on this real life journey and how he evolved as a trader and got bigger and bolder and highs and the lows of his trading career, which is fantastic.
Yeah, fantastic. Yeah, awesome. All right, Richard, well, I'm going to wrap it up there because we're pretty much out of time now. But it's been fantastic to catch up with you again, hear what you're up to, hear that the portfolio is still going well. You're still passionate about markets and making a success of it. It's inspirational. And as I said, you're a regular guy, not from the industry, not a professional money manager, but doing it yourself and making a success of it. And it's inspirational to the listeners, hopefully, as well.
Thanks, Garth. It's been great chatting to you again. And look forward to listening to some more podcasts from your feed. Very
Super.
educational, and keep it going, please do.
Thanks very much. Take care, Richard.
Cheers.
Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.